Hello and welcome to episode 32 of the Wealth Amplifier podcast. Patrick Swift today doing the interview series and very graciously joined by Lauren Gilchrist from Newmark. Lauren, welcome to the podcast.
Awesome. Thank you, Pat. It's really good to see you, and it's really awesome to join the Amplius team on your podcast.
I figured we can start there with some intros. So obviously you and I know lots about each other, but for the audience, I figured, why don't you tell us a little bit about yourself? And also, I think most people are probably familiar with Newmark and who Newmark is. But if you don't mind, give the audience a little tidbit on for those who don't know, maybe.
Sure. Well, thank you so much. Again, as Patrick said, I'm Lauren Gilchrist. I'm the EVP and Market Leader for Newmark in Greater Philadelphia. Newmark is a full-service commercial real estate firm, which means that we do anything and everything that anyone who owns commercial real estate, so non-owned residential real estate, would want to outsource from their particular holdings. So we lease buildings on behalf of owners and represent tenants in lease negotiations. We sell buildings on behalf of owners and help folks to purchase buildings. We finance buildings. We do construction project management. We do property management. We also do valuation and advisory on the appraisal side. So in short, anything that anybody needs expertise, we are happy to provide that expertise. We are one of the largest commercial real estate services firms in the world. And I happen to be lucky enough to lead the Philadelphia team. So here in Philadelphia, we have 4 offices around the region, Center City, which is where I am, the Pennsylvania suburbs in King of Prussia, Marlton, New Jersey, as well as in Wilmington, Delaware. And we have about 110 professionals that roll up to me across all of those different service lines throughout the region. So I've been in this role now for about 2 years at this point in time. I've been in the commercial real estate industry for about 10. I spent a little time on the principal side for a large private life sciences developer. Prior to that, I was at a competitor of Newmark's doing market research. That's kind of my stock and trade is market research. And prior to that, I spent some time in the public sector here, both in Philadelphia and as well as the Arlington, Virginia area. So I've seen a little bit of everything related to the built environment.
Love that. I think that is an excellent kickoff and background on both yourself and Newmark. So, and just to clarify, so Newmark is a global firm. Am I wrong in
That's
that?
Correct. Yes.
So you oversee, obviously the firm is involved in not just domestic stuff in the U.S. and obviously the Philly region, but all over the world. So pretty major in terms of your guys' overreach. So you have a pretty good, both yourself and with the firm you work with, some pretty important insight into commercial real estate, not just in the U.S., but across the globe.
Yeah, that's right. We are increasing our international footprint all the time. And we have about 7,600 professionals across all of the markets that we cover, both domestically and internationally.
Very cool. And let me ask you real quick, too. This is off script, but as you move from a market research role and some of the background you had prior to coming to Newmark, how does it feel going from that to a position where you're now overseeing many professionals across different veins, dealing with, maybe some personality differences and all that kind of stuff, fun stuff? How has that? Has it been a fun challenge for you, or?
Well, it's in some ways just the evolution of, I guess you could say, my leadership journey. I have a really strong set of tools that I've utilized to begin to build my understanding in this sector, going back 10 years. And what I was very lucky to have experienced was to have those tools be embraced by the professionals, by the brokers, in terms of our ability to develop, pitch, and win business. I really focused a lot of my time and energy on taking the research piece of things, which in some cases was more viewed as a kind of back office position, and turn it into a client and customer facing position, whereby I developed a consulting business, but also was involved in some of the firm's local largest pitches in terms of both cultivating that through just really quality data and information, but then subsequently helping to win it. And so it's been an interesting evolution. I'm somewhat young for my role, so it's been great to be at Newmark, where folks have invested a lot in me personally as I evolve in my chair here. But brokerage is brokerage, and the problems and the opportunities are the same no matter what part you're kind of looking at the industry from. So it's been a lot of fun. What I would say is I have a lot of people that report directly to me, and they're all independent contractors, and they're wonderful, but they kind of have lots of different needs and lots of different things going on at all times. So it's been a big, fun challenge.
Yeah. And I would imagine what makes you a successful real estate professional, the folks that you oversee, can also be difficult to manage as a person that oversees those people from time to time. So it's probably a fun environment and a challenging one, I would imagine.
It's awesome. It's an awesome role, and I'm very lucky to have such a great team around me.
Yeah, that's excellent. All right, so should we dive in a little bit to the state of commercial real estate, both sort of macro level, but more specifically in the Philadelphia region, as a lot of our clients and folks that listen to this podcast are participants and occupants of many buildings in the Philadelphia region, all that kind of fun stuff. So maybe just to kick off, especially with your market research background, give us kind of the rundown of the state of commercial real estate these days. I know that's probably loaded because it's such a sort of big question that can be very general, but how would you sort of describe it today? Maybe just in the US kind of broadly.
Yeah, there's so many different directions to go with this. And, what I will talk about, I think, to just start is some of the challenges with being a bit of an interest rate driven business. Right. I don't think it's any surprise, to anybody, unless they haven't been paying attention for a while, that we've been in an inflationary environment, that the Fed has done its best to tame and tamp down over the last couple of years, which means that the cost of acquiring real estate has increased as a function of that interest rate environment. This has an impact both for the folks that have floating rate debt, as they have seen, the costs of their day-to-day, regardless of the occupancy of the assets, increase because their borrowing costs have increased. And, as a result of that, it has become a bit cooling, which is what the Fed has attempted to do in the market overall. So that is not surprising, I think. The impact, I think, has been varying across markets. And subsequently, we also need to talk about, the impact of the post-COVID environment in terms of how people are utilizing space on the occupier side. For example, we've seen pretty substantial downsizings of office leases. We have in some cases seen some flight to the suburbs in certain pockets of the world, or a flight to the southeast on a macro level, as people have the opportunity to work from anywhere they want to. And in a lot of ways, the disruption of COVID has just caused a number of shifts. Some of them were amplifying shifts that were already underway, and some of them kind of were unique shifts to COVID. And when we think about Philadelphia overall, we are a kind of slow growth market. We're a secondary market from an investment perspective, which is good because we don't see the low lows of some of these structural changes, but we often don't see some of the high highs that the gateway markets, San Francisco, New York, Boston, might experience. And so, what that means is that it's sometimes challenging to get your hands around an acquisition in Philadelphia if you're an investor. It also means kind of planning for growth as an occupier. You often don't, take space in excess of what, you really know you need on a day-to-day basis, because growth is, typically slow and steady. So we just don't see a lot of that really hard charging momentum, in the good times that, in New York would see, for example. So overall, I would say the market's generally healthy across all asset classes. Office is seeing a lot of substantial change. We continue to see good, strong, hearty interest from investors in multifamily in the suburbs, as well as from renters. We're seeing the structural shifts in retail that everybody else is experiencing as the way we shop changes. But the market's healthy, and we have some things that we need to kind of work through, especially on the office side. But, the positioning of Philadelphia hasn't necessarily changed in the last 2 years.
That's interesting. And you keyed in on, obviously, a ton of the I think things that the average consumer of news sees, right? The effect of COVID and how it's obviously affected the various asset classes in commercial real estate, but also the inflationary period we've seen and how interest rates have obviously, which is always a large input to real estate transactions. A couple of things I definitely want to unpack in there, but almost one right off the bat, just to clarify for the audience, correct me if I'm wrong here, but across commercial real estate, there's all kinds of subcategories, but your major asset classes are the following. And like I said, correct me if I'm wrong here: multifamily, office, retail, industrial, warehousing, yes, and kind of mixed use. Am I missing anything in those?
No, that's accurate. There are a lot of niche asset classes,
of course,
like
right,
data centers or medical office buildings, but those are, I would even maybe exclude mixed use because we kind of will categorize them based on the predominant, but you got it. Yeah.
Right. All right. Nice. All right. Score one for my side. So specifically with some of the office buildings. So obviously that was one that has received a ton of headlines, and it's interesting. I hadn't really realized the secondary nature of a Philadelphia market. It makes a ton of sense the way you just sort of eloquently describe how it works relative to a big market like New York. Doesn't experience some of the high highs, but doesn't experience some of the low lows as well. Interesting from an investment standpoint that I hadn't really considered before. But let's talk about downtown Philly just in general for a second. Have you seen, let's just talk in COVID language here for a second. Have you seen, a big return to office just anecdotally in your own experience living in the area? Have you seen it from what you guys are doing day to day? Has it been slower, faster than you would have expected? What's kind of the state of the micro Philadelphia market?
Yeah. So I believe the last set of stats that I had looked at suggested that more than 60% of everybody that is expected to be in an office for the majority of their workday is in fact back in the office. And what that really means in terms of how it feels downtown is it's quite vibrant. I mean, I'm about to go out to lunch in a couple of hours, and I'll generally walk there, and there'll be tons of people out on the street. Call it Monday through Thursday, right?
Sure.
So the feel is really good. What has happened as we've shifted again towards maybe a little bit more hybrid, even 1 to 2 days a week for some folks, is that a lot of office occupiers have looked at their space and they have said, do we really need all of this space? Do we really anticipate everybody to come back? And we, upon lease expiration, have been seeing, in the last couple of years, anywhere between a 40 to 60% downsizing of overall office space, which is dramatic to be sure. That number seems to, upon the latest leases that we have seen, shifted to more about 20% shedding of space.
Okay.
But I can also tell you that, when the pendulum swings kind of far one way, it often swings back to the middle. And we've seen a number of occupiers begin to say, oh, shoot, we're more back in the office than we thought we were. We actually downsized a little too far and we need to go for space. Yeah.
Sure. And have you seen, you mentioned a little bit how there's been maybe more dispersion because of the flexibility of that a lot of employees have these days, but also to your point, the decision makers have decided, hey, maybe we don't need as much space. And has that impacted to the positive the sort of suburban office market in the Philly region, where you've seen maybe folks go from a multi-floor center city building to maybe a couple of leased spaces in a suburban market, or are those not as correlated as one might think?
I think everybody theorized that we would see a massive outmigration to the suburbs. And generally speaking, the answer has been no, or it's been limited.
Sure.
What we've more seen has been what we would call a flight to quality, which is tended to have been in, call it, so we categorize buildings: trophy, class A, class B.
Yep.
So say a class B building, they, upon lease expiration, have the opportunity, because we've seen, some softening of rents, not substantial, but a little bit, the opportunity to get more efficient, in their space utilization. So shed, call it 20% of that space, pay a little bit more in rent, but maybe not top of market rents like we would have seen before COVID, and get into a nicer location in a nicer building with better amenities. And so any shifting has really been more that flight to quality than necessarily a flight to suburban markets. But we've seen a little.
That makes sense. And to maybe to put that into micro examples for the Philadelphia market. Trophy building, correct me if I'm wrong here, would be something like the Comcast Center, Liberty One, Liberty Two, Cirrus Center, those big buildings that everybody kind of recognizes.
Yeah, that's right.
Okay. We'll segue a little bit, but I'm curious for this too, because we've heard a lot about the general public, I'll say that is, where office buildings, let's say maybe the Class B or some of these units that are maybe difficult to project as to what their occupancy might be and what the leases might be. There's obviously a ton of demand for multifamily in not just our region, but the entire United States. And I want to talk more about that in a second with you. But there's been a lot of discussion around conversions from traditional office space to residential space. How have you seen that play out? Do you think it's like to use your words, a pendulum swinger where it may not go as far as some have predicted? How do you see that shaking out? What has your experience been kind of with that?
Yeah, I think there was a lot of enthusiasm for the exploration of office to residential conversions. And what's challenging about them is that the floor plate and the design of the building has a lot to do with the feasibility of the conversion. Pricing also has a lot to do with the financial feasibility of the conversion. And so when we think about buildings that have been converted or that are in the process of being converted right now, they typically have smaller floor plates. And so when you think about an office building, the floor plate is essentially one floor. That floor will include restrooms, it will include common areas, it will include elevators. And, the depth of the line from the window to the core of the building dictates the amount of light that can flow into the building. If you look at pre-war buildings or kind of smaller floor plate buildings from the early 20th century, they often convert really well because the depth from the core of the building to that window line is minimal. Whereas a lot of office buildings that were designed, call it in the late 20th century, or even ones that were, designed after, call it 2010, there was a shift to larger floor plate, larger format buildings in order to get more people, more amenities, and more stuff. And so, we in Philadelphia had seen probably 9 million square feet of obsolete office convert prior to the pandemic to a combination of hotel and multifamily apartment and condo uses. So we had already kind of gobbled up a lot of the good conversion targets. Now we have this, kind of structural change in how we use office, and we're looking for more of these opportunities. But the reality is there's a couple of buildings that are feasible for conversion. There's a lot that just really aren't, or you'd have to put so much money into them that it's not financially feasible.
It's no longer right. That makes a ton of sense, and I think that's. I had heard someone put it in such simple terms that made sense to me, which is. The feasibility, it sounds great on paper, right? Hey, we'll take a beautiful building and we'll convert it into residential because that's what the market may be demanding at this point. But if you have an office building that's expansive, like you just mentioned, and one floor has one bathroom on it and you're going to convert it into 15 apartments, how are you going to get 15 bathrooms in there? Like someone used that example for me and that really put it into context where it's like that would be very expensive. It would be very time consuming and it makes the project sort of not worth it. Okay. So I want to shift even more into kind of multifamily because it's been maybe correct me if I'm wrong here, a really hot part of the commercial real estate sector as we've experienced in the U.S. really throughout the country. The old American dream has become less affordable for a lot of people with interest rates rising, with inflation on the rise as we've seen the last handful of years, and the sort of single home family residential market just being as hot as it's ever been. It's been the affordability of buying a single family home has been more and more difficult for the average American. And you've seen a lot of this sort of multifamily space fill that void. Is that another pendulum moment where it feels like we've maybe gone too far and maybe it does swing back at some point? Obviously predicting interest rates is quite difficult, but how do you see that playing out? Do you see any overbuilding in certain markets? Do you see the trend continuing? How do you see multifamily and its kind of intersection with single family homes?
Well, the reality is that as a growing country, we have basically a limitless demand for housing at this point in time. Now, you could project out, 20 years with the birth rate and start to think about, will that remain true for 20 years? But right now, we have substantially underbuilt the volume of housing that we need in the United States, which is causing a lot of those headline affordability problems, both in terms of the for-sale market, but also in terms of the rental market as well. When I moved to Philadelphia, call it 12 years ago, I rented an apartment for $1,300 a month, which was cheaper than my studio apartment in Washington, D.C. So we have the benefit of affordability in Philly to a certain degree, but prices have increased significantly, especially, since COVID and sort of the kind of ramping down of some of the COVID challenges. So it's important to remember that we are undersupplied in terms of housing in the United States. And the only way to correct for an undersupply is to let the market build. That the only economic way to do it is to kind of take the reins off of, private capital and to say, go build as much as you can, because if there's money to be made, the private market will go and build. Right. That's not always appropriate, kind of at the individual community level. But part of the challenge with affordability and availability of housing has been the fact that, we do have a bit of a not in my backyard kind of culture where people don't like change. And that makes a lot of sense, in some ways, but also, becomes very challenging if you're not willing to embrace it, especially if it impacts your home value.
Right.
When we think about oversupply and we think about whether or not we are oversupplied in certain places, it's important to think about, what the specific market dynamics of are a micro area, right? So in Philly, we saw a bit of a shift where we got, thousands of units out of the ground in the last couple of years due to the ramping down of the tax abatement, the 10-year tax abatement. And so there's been a lot of construction momentum, especially in the Fishtown neighborhood. When folks ask me about it, I say it's going to take maybe 2 years to 3 years to absorb the supply. But will the supply eventually get absorbed? Absolutely, because we've been historically undersupplied in terms of the market, but also undersupplied in terms of quality. If you drive around parts of Philadelphia, it's very clear that a lot of the assets have been underinvested in the neighborhoods. So we need to think about how do we recapitalize or reinvest in these assets to make them great places to live. And so a lot of the new construction is really filling that void for quality housing in certain locations.
That makes sense. And it makes it exciting too. I mean, anecdotally, as a former resident of Fishtown, it was exciting to see all that was going on there. And it was really making it continually vibrant community to live in. A lot of the sort of retooling of historical assets into homes where it was trendy and cool and mixed use. And it's interesting to hear you kind of describe the state of things. And that certainly has been the case that I've heard as well. It's just we're undersupplied as a country. We're undersupplied in so many markets specifically. And if you build it, they will come, right? Like that's a true mantra in this case. So shifting a little bit again, I want to talk on a few more sort of headline grabbers, if you will. Again, more on the positive side. We've heard a lot about. I actually was at an investment forum in the fall time, and I hosted a panel. I don't know why they picked me, but to talk about energy infrastructure in our country. And the reason why I'm bringing that up in our conversation is because we've heard a lot about these AI technology behemoths, right? Look at the stock market. The biggest companies are now the NVIDIAs and the Microsofts and these companies that are investing in this new technology. And there is this enormous demand for filling that technology with the right resources, which in a lot of cases is power plants, things that are going to be able to draw power for the computing load that we're going to need to supply. And that obviously hits your world pretty hard. So curious in the sort of industrial space and the power plant building space, if you will. Are you seeing a lot of that? I don't know if you intersect with it personally much, but how are you seeing that play out? It seems like we are way underbuilt there as well. But I'm just curious how you're starting to see some of that play out with this new technology.
Yeah, so I think there's a couple things embedded in that. First of all, I'm lucky to serve on the board of the Philadelphia Facilities Management Corporation, which oversees the Philadelphia Gas Works. And, we think a lot about, energy sustainability, but also the future of the gas company and how we can be prepared for, all of the things that we need to related to the environment, related to the utilization of energy across the city of Philadelphia, et cetera. So, I can say that this is on everybody's mind in terms of, how do we prepare for the future, both, in terms of the changes that we're seeing, but also just the general day-to-day growth and consumption of energy across the country. So in terms of the real estate, very specifically, it is a niche asset class still in terms of data center utilization, right? It is a little bit different and specific versus just generalized industrial warehouse. But,
Right.
We've seen over the last, call it, 10 years or so, a dramatic change in the industrial market, even as we've seen consumers, shift their shopping patterns more to e-commerce and online.
Sure.
Even small fractional changes have produced, demand for millions and millions of square feet of industrial space. And while we begun to see that cool a little bit in the last couple of years, by the time we gobble up the supply that's under construction right now, it'll be time for a new wave of supply to hit the market to be able to meet the demands that you're suggesting from, additional computing power, additional energy production, et cetera. So while it might have slowed a bit, we anticipate long-term growth in the sector for sure.
That makes a lot of sense, and it's a good call out by you too. I know in our region of Pennsylvania more broadly, there is a ton of warehousing for the Amazons of the world, and they've bought up a lot of that land and real estate and developed it probably far more than anyone would have guessed 20 years ago. So those are sort of emerging trends that I just think are fascinating to see how quickly we try to fill that demand. So I was curious about your perspective there. So to turn again towards something that is less fun to talk about, but obviously we're in the midst, when we're recording this, of the awful situation out in LA. And not to really speak to that one example or situation, but I think across the country, we've seen insurance costs rise. Homeowners insurance has risen, maybe not equally in certain markets, but the coastal areas of our country has certainly been hit with more natural disasters, and insurance costs are going up, and some places are becoming uninsurable. That topic has seemingly risen in terms of concern incrementally over the last 12 to 18 months. And I'm curious, obviously it's a major component of when you're building a new project, and you're financing or you're valuing certain aspects of real estate. So I'm just curious, obviously I'm sure you've seen your guys' business impacted, but there's so much unknown right now, specifically with what's going on in LA. And I'm just curious how you're thinking through that and what the impact could be, and what's the glass half full version of it too, because it seems like everyone is so negative about how insurance costs have risen.
Yeah, I'd say that, one of the challenges is that markets perform best under conditions of certainty, right? We are not in an asset class that is highly liquid, which means that, we can't go and sell it on the open market, tomorrow if we decide we want to get out of a particular multifamily building or a particular office building, right? So when the underwriting change, insurance is a component of the underwriting. And when one of those fundamental assumptions about costs changes, it changes the returns. And it could possibly also then change, the ability to cover, debt on a particular asset. And so any kind of macro change in the cost structure is challenging. But I'll say we had begun to see some of this in the market prior to any of the wildfire activity, that we're experiencing on the West Coast. And, the market has slowly begun to adjust to that, but oftentimes what will happen is it will, change sort of the buy, hold, sell kind of calculus for investors, because they're looking to hit a certain return threshold before they would look to exit an asset. So does it change the length of hold? Potentially, yes. Does it change other things about a project? Sure. But, at the end of the day, I feel like we've begun to adjust to some of those rising costs long before some of the extremes, began to occur over the last couple of weeks.
Yeah, that's fair. That makes a lot of sense too. And it does feel a little bit like there's so much negativity focused on that right now. Who knows how it actually bears out as we start to see, at least in LA, how we rebuild there and who's going to be insuring those properties. But it's it's obviously a big topic right now.
Yeah.
Curious too, what's your opinion, if you will, on you've seen some discussion around insurance as traditionally or is a state sort of regulated industry. So as you see in Florida, some of the natural disasters we saw there last year, there's this discussion of should the risks that insurers are taking on be concentrated to those in that market, or should it really be spread out across the rest of the country? And for someone who now lives in suburban New Jersey, I can say personally, I don't want to take on the extra insurance costs with someone who lives in, Tampa Bay, Florida. However, I also understand that in order to make those markets potentially affordable in any sense, that might be the only way to go. Have you seen this kind of topic come up? And what are your thoughts on sort of sharing costs across markets for these insurers to be able to even insure certain markets? I don't know if it's a big topic you've seen, but I've heard it kind of kicked around.
I'm not seeing the discussion firsthand on a day-to-day basis, if I'm being honest. But, I will say it, much like health insurance, right? When you spread the risk across, both very risky pools and less risky pools, you get to, a place where, each end of that spectrum can exist somewhat comfortably. So I feel like there's probably a policy response that needs to occur here as a function of the fact that, it does. I'm a believer that the climate's changing and that, these natural disaster events are going to become more frequent. So I expect that this is going to be an ongoing concern for property markets, and we're going to need to think creatively about it.
Yeah, I think you're right. And generally, although I'm a believer in the private sector being innovative, it might be one of those where you do need some government involvement to figure out how to best tackle it. So fair enough. So we're a little over 30 minutes. I think we'll go for a little longer because this is, I think for me at least, a fascinating conversation. One other thing, and not to harp on any negativity at all, but I'm just curious for your perspective. We had, I want to say, if I'm remembering correctly, maybe coming into 2023, there was so much discussion around, now that we're in a rate hiking environment, floating rate debt and commercial real estate, comboed with the vacancies we were talking about in office buildings particularly, was this canary in the coal mine for the economy. And sitting here today, and maybe knock on wood, that has not really bared out, which is a good thing, right? We haven't had this blow up that so many people were predicting, which is great. But I'm just curious, and you and I actually had spoken about it sort of on a personal level a couple of times, but how are you seeing how that prediction has sort of shook out to date? Are we missing something? Is the economy chugging along because we've got all these other shock absorbers? What are you seeing in terms of that whole refinancing bubble that so many people were talking about for so long?
Look, I would say lenders are highly incentivized due to the magnitude of the challenges to work it out with their borrowers. You do not want these assets on their books written down to a fraction of their initial underwritten value. And I do think that there is call it a medium-term belief that things are going to work themselves out. We're going to need to get creative. We're going to need to get gritty. We're going to need to try things that we've never tried before. But that is a far more palatable outcome in some cases. We're saying extend and pretend for a while. I don't want to necessarily harp on that trope, but to work it out with borrowers, because it doesn't benefit anybody to see a sudden massive write down of assets and have them kind of go to market, at potential fire sale prices. So yes, I think we'll see some of that in certain pockets on individual assets. But for the most part, I would say that, borrowers and lenders are kind of in it together a little bit here, because the scale of some of the challenges is substantial. And so, I would say, the economy continues to perform well from an employment perspective. Real estate is a fundamental piece of infrastructure when it comes to living, working, playing, et cetera. I do think we'll see some shifts in the desirability of certain locations, certain assets, certain ways of working and ways of living. But, overall, I don't think that we ever got to be massively overbuilt, in the office market, especially in Philadelphia, for sure. So I think it's just a matter of looking towards that medium term and kind of riding it out a little bit.
That makes sense. And having married incentives between parties certainly makes for usually innovative ways to solve the problem. So, and that seems to be what has taken place so far. All right, so let's shift a little bit. Last couple minutes here to Lauren personal again, because I know you are involved in so many initiatives. It's so impressive from the outside looking in to see all the things you're involved in, and a lot of them are such sort of noteworthy and noble causes. So I'd love for you to, being on the Wealth Amplifier, kind of amplify some of the things you're involved with, and really what makes you tick, and what kind of things are, get you excited to support on a daily basis.
Well, I appreciate the chance to talk about it. I spend a lot of my time committed to personal, professional, volunteer activities, and I've done this for a long time. And what I would say is that I'm very grateful to serve on the board of Ensemble Arts and the Philadelphia Orchestra. It's probably my favorite volunteer activity that I'm a part of. And it's really a group of people that are overseeing and helping to assist the management and the operation of the Kimmel Center, the Miller Theater, the Academy of Music, and the entire portfolio of real estate, but also artistic individuals and groups, that come through and make Philadelphia an amazing place to see art. I'm very lucky to be a part of that. I served as the co-chair of opening night of the orchestra last year, which was a heck of a lot of fun. And what an honor to be asked as well. But that's been probably my favorite volunteer commitment in Philly. I'm also heavily involved in Bucknell at this point, at the Freeman College of Management in the Dean's Advisory Board. So I graduated from Bucknell in 2007. So it's very much kind of in the rearview mirror. And it was amazing to be brought back in first to the real estate advisory group, but now the Dean's Advisory Board, to be able to shape the future of management education at Bucknell. I benefited so substantially from it, but also think that there's a lot that we can be doing to help current students and future students and alumni and kind of knit things together, because it's an amazing education. And now we just need to keep building some of the infrastructure around it to help the program realize, more of its full potential. So I spent a bunch of time on both of those things and some other stuff as well, but those are two of my favorites.
Yeah, that's very cool. Very cool things to be involved in, giving back to your alma mater and just being able to participate in a lot of that, I think for most people is something they can relate to and kind of praise you for, because I think that's just cool work. And on the orchestra side, yeah, it's you're helping contribute to the vibrancy of our community in Philadelphia, which is, the art scene is something that is historically beloved in Philadelphia. So it's people like Lauren that help make those organizations tick. So we appreciate it. But anything else you want to amplify on this particular episode?
The last thing I'll just mention is just my ongoing commitment to NAIOP, which is the Commercial Real Estate Developers Association in Philadelphia. I spent a lot of time co-chairing the Government Affairs Committee there and working to make sure that we have a political and policy environment that's conducive to the ongoing success of the industry, both for the sake of the industry, but also for the sake of the community as well. Right. Surfacing some of those issues in city council and with the mayor, is something that I'm very passionate about, because I think we are a great city and we can do better. And having an opportunity to have a seat at the table has been a real honor, especially to get to work with the board members of the organization. So I've spent a lot of time on it for a long time now, and it's been really gratifying to be able to be at the forefront of pushing forward change in the real estate industry. Yeah,
well, you're involved in really impactful ways to see your own lived experience change in the city that you're participating in. So that's very cool. I think the audience, the listeners are going to love this episode. We may have to have you as a reoccurring guest to speak on commercial real estate and give us your tidbits, because all of the topics we sort of touched on, I think we could delve into even further for a lot longer in different formats. So thank you so much for your time. This has been amazing and illuminating for me. I'm sure our audience will feel the same, and we'll have to have you back on, like I said.
You got it. Anytime. So nice to be with you. Thank you for the opportunity, and happy to help in any way I can.
Awesome. Thanks, Lauren. Appreciate it.
Patrick.